Tesla, JP Morgan, Zillow, Twitter, Netflix, Oracle, Redfin, Coinbase. In the last 30 days alone, these large Wall Street companies have all announced big layoffs, yet another sign that the 2022 recession is getting even worse. Because as we can see on this graph, the number of large companies announcing a layoff has skyrocketed. It's gone parabolic, up to 114 companies in June announcing a layoff. 1 year ago, it was only 10 companies announcing a layoff. Why is this happening? Well, Wall Street CEOs see the writing on the wall for the US economy, and they clearly expect this recession to get worse because according to Elon Musk, the CEO of Tesla, the US is probably in a recession that could last as long as 18 months. Meanwhile, Mark Zuckerberg, the CEO of Meta/Facebook, just said that this might be one of the worst downturns we've seen in recent history. And these pessimistic thoughts on the US economy are shared by other big CEOs. Data from the Conference Board just showed that CEO confidence turned negative in the second quarter of 2022, and most notably 68% of CEOs expect a recession in the next couple of years. And the reason these Wall Street CEOs are so negative on the economy and the reason that they're doing layoffs right now is because they know things are about to get a lot worse. They know that right now the US is in a massive debt bubble where the total debt between corporations, government, and consumers is nearly 300% of GDP, the highest level of all time. On top of that, they know that we're in a raging asset bubble where the value of the stock market and the housing market is also near 300% of GDP. And they know that a combination of a debt bubble plus an asset bubble is bad news for the future of the economy, especially in a rising interest rate, highly inflationary environment. And it's very likely that as inflation continues and as Jerome Powell and the Federal Reserve hike interest rates, we're going to see this debt bubble and this asset bubble collapse. And it's these layoffs which are warning you all that this is coming. This is just the tip of the iceberg, seeing Tesla lay off 10% of its salaried workforce, seeing Redfin and Zillow and real estate companies lay people off, seeing mortgage origination companies go bankrupt. This is a sign that things are about to get a lot worse, especially in a state like California, which you can see on this map has by far the largest share of layoff announcements in America. Over 100 companies so far in 2022 in California have announced layoffs. That's way higher than anywhere else in America. New York is second place at 50, Massachusetts is third place at 34, and if we dig deeper, we can really see it's 3 or 4 metro areas, San Francisco, New York, Boston, LA, and Seattle, that are leading the charge as far as the economic devastation that's coming from layoffs. But what's scary, everyone, is the likely contagion effect that we're going to see from the downturn in these cities, which are predominantly tech-oriented. We've seen it's mainly tech companies that are having the biggest layoffs so far. Well, that's going to be a problem not just for tech, but the entire economy. That's because tech and innovation workers make so much money, they have such high wages that when they go to spend that money in the local economy, it creates jobs everywhere else across the economy. And according to Berkeley economist Enrico Moretti in his book New Geography of Jobs, one tech job can create up to 5 additional service jobs in the local economy. So all of a sudden now, when tech workers are losing their job, that's going to create job losses everywhere else across the economy. However, this is going to take time to play out. If we look at the data right now in America, the unemployment rate is near a record low 3.6%, while initial unemployment claims are only around 220,000 per week, also near a record low, which means that we haven't even seen anything yet in terms of economic pain, and that we have a ways to go before we see a bottom in the economy, the housing market, and the stock market. And so you can all understand this point more clearly of why we're not in a bottom yet and when the bottom is likely to come. I'm going to show you some data from previous recessions, because these previous recessions can teach us a lot about what's going to happen for the rest of 2022 and into 2023. And one place I want to start actually is the dot-com bust in 2001. And on this graph, we're comparing the yellow line, which is the value of the S&P 500, to the blue line, which is the unemployment rate. What I want to point you all to is that the S&P 500 peaked in August 2000 and then went down by about 46% over the next 2 years. It took 2 years for the stock market in 2001, 2002 to bottom. Now, interestingly, the unemployment rate remained very low even as the stock market crash was going at the end of 2000. But then all of a sudden, everyone, the unemployment rate started to surge. And between December 2000 and December 2001, it went from 3.9 to 5.7% in a big surge upward. And this is something you really need to understand about layoffs and unemployment, is that they tend to start with a trickle and then they explode at a certain point. And right now we're in a trickle of layoffs in 2022. Like, there's been a big increase, but overall we still have low unemployment and low initial unemployment claims. But folks, that's not going to last for long. Another recession that's worth looking at is the one that occurred in the early 70s. This was an inflation recession. Bear bearing some similarities to what we're seeing right now. There was a big surge in inflation around 1972, 1973, and as a result, the S&P 500 crashed by about 46% over the course of a year from 1973 to 1974. That's the yellow line. Now, what did unemployment rate do? Well, again, you can see unemployment stayed pretty low for a while. Even as the stock market was crashing, it only went up slightly, and then boom, from May 1974 all the way to May 1975, the unemployment rate nearly doubled from 5.1 to 9%. And so let these historical recession episodes be a lesson to you all of where we are right now in the economic cycle. And if you were someone who thought maybe we're at the bottom of the stock market downturn, or somehow that this housing downturn is just going to bounce back right away, folks, it's not, because we haven't even seen anything truly bad happen yet in the labor market. That's going to be coming over the next 6 to 12 months. There's going to be a lot of layoffs. The unemployment rate's going to go up fast. And as that happens, of course, it's going to suck more demand out of the economy. It's going to lower consumer spending further and push asset prices down by even more. Now, I know to a lot of you that sounds like a very bearish, cynical perspective on the economy. So let me justify that for you all. Why do I think that we're not just entering a mild recession, that this recession is going to be more severe than people are anticipating? And it has everything to do with that trifecta that we're seeing right now of the asset bubble combined with the record debt bubble to go along with raging inflation. And it's that raging inflation, that last one, that really complicates the story. It complicates the scenario because over the last 15 years, the US federal government and the Federal Reserve got so used to printing money and taking out debt to stimulate the economy. And, in my opinion right now, the US economy has been propped up by this debt and by this money printing. Well, with higher inflation, that's no longer really a viable alternative. You can't really justify sending stimulus checks out or printing money when the inflation rate is 8.5% year over year and the unemployment rate is 3.6%. Like, this gap between the inflation rate and the unemployment rate means that the Federal Reserve and the US government is trapped. They are not going to be able to rescue this economy again, at least not in the next 6 to 12 months, I don't think, because as long as that inflation rate stays stubbornly higher than the unemployment rate, Jerome Powell and the Federal Reserve are going to have no choice but to keep increasing interest rates and to keep restricting the money supply. And it's those actions which are inevitably going to pop the combined asset and debt bubble in America, because as the cost of debt, as the cost of capital becomes more expensive, that's going to lower the value of assets, and that's going to make it very difficult for corporations, consumers, and the US government to refinance existing debt obligations. It's going to increase the cost of debt service, which is going to mean less money going into the economy for productive purposes. But I do believe there's one potential lifeline. There's one way that we could potentially get out of this mess of being in this combined debt and asset bubble with rising inflation and not have a crazy crash. And that would be simply if inflation started returning to normal over the next 6 to 12 months. Like, if we see by the end of 2022, the year-over-year inflation growth rate is down to 3% or 3.5%, that could help us avert a cataclysmic crash, because it would mean that the Federal Reserve wouldn't have to increase interest rates as much going forward. Again, that has to do with the inflation rate going below the unemployment rate. Is that going to happen? Well, maybe, everyone. I mean, on one hand, we have consumer goods deflation right now. We're seeing a lot of price cuts and liquidations on heavy goods at retailers like Target and Walmart and Home Depot and Dick's Sporting Goods. So we're seeing deflation in consumer goods, and we're going to start seeing deflation in the housing market and rental rates very soon. However, on the other end of the spectrum, gas prices and food prices are surging out of control, which is going to likely keep inflation elevated going forward, even as we start to see deflation on consumer goods in the housing market. So I'm personally skeptical that by the end of 2022, we're going to see inflation go down to a level where the Fed is going to back off their interest rate hikes and their monetary tightening. But let's play devil's advocate for a second and say that inflation does go down to 3% year over year by the end of 2022, and the Fed can back off its interest rate hikes. And as a result, say we avert a cataclysmic debt crash. I think even in that scenario, we're still likely to see a recession and still likely to see a housing crash, because right now, home prices in America adjusted for inflation are at an all-time high, even higher than they were in 2006. Meanwhile, rents as a percentage of income are at an all-time high as well. So if inflation starts moderating, that will likely mean home prices and rents need to go down. And the associated downturn in layoffs and housing will likely be enough to cause a recession on its own. So the moral of the story here is that, folks, there is actually no easy way out of this situation right now. When you have record high debt, when you have record high asset prices to go along with rising interest rates and inflation, it's going to be a messy combination, and the end result is going to be a recession that's not just a short and mild one, but one that takes years to play out, which means my prediction for a market bottom when you can get the best deals on stocks and home prices is likely to be not until the end of 2023 or early 2024. Now, one last thing, everyone. I have some parting words for you all in this video, and it's related to a book I mentioned earlier in the video called New Geography of Jobs by Enrico Moretti. This book, New Geography of Jobs, it changed my life because 3 years ago when I was in Boston in the summer of 2019, I had quit my job. I had nothing going on. I had no income. I was paying $3,000 a month in rent. I was pretty down in the dumps. I didn't know what I was going to do with my life, and I picked this book up and I read it, and it changed everything. I can remember reading it in the park in Copley Square in Boston, getting excited reading this book because Enrico Moretti talks about all the different cities around America and their demographic growth and why some cities were growing and other cities weren't growing, and he ties it into tech job creation. He also talks about local housing markets, and after I read this book, I knew it was my mission to start Reventure Consulting. I knew it was my mission eventually to start this YouTube channel and to try to really figure out why certain cities grow and certain housing markets grow and what creates a bubble. So I wanted to just recommend this book to you all out there. I think a lot of you will like it, especially if you like the content on my channel.